a lot of people think fundamentals are going to add value. And the last thing is you can make money on the short book in your portfolio because short-term rates are high. You might get another 2% return based on the interest on the short book.
You mentioned that most of the funds are with a relatively few managers, the Citadels of the world. How did that come about? I mean, it used to be a day where if you had hotshot trader at Morgan Stanley or Goldman Sachs, you could go out and raise $500 million or $1 billion. That's not as prevalent today, is it?
It's not, and I will say that is one of the big issues with the industry is a lot of people buy brand. They think, there's safety in brand. A lot of these top managers had phenomenal track records a long time ago. They're managing way too much assets. Their returns have been very mediocre for a lot of famous hedge funds. A lot of these pods have done very well recently, but they've gotten very large. Mm-hmm. You're beginning to see some money focus more on smaller managers. Smaller managers, if you want good returns, is where you want to invest, but you don't want to invest in them unless you understand the inefficiency that they're focusing on and what their differential advantage is to capture that inefficiency.
Mm-hmm. What about all the main strategies like volatility-focused funds, CTAs, like the trend followers? What's the interest there?
So there's been a pickup in interest for commodity trading advisors, and basically they're people that invest in financial futures across the four main capital markets, and they're quantitative managers that are looking at price patterns historically, and they tend to do very well during market sell-offs. So they help protect markets if the market's going to sell off, help diversify. A lot of people are worried about valuations of the equity marketplace, so that's one way to diversify away from equities.
How about pricing, fees? Is 2 and 20 still the game?
So is this why you don't like hedge funds, because of the fees?
Yeah, no, I love the fees.
So he likes the fees.
But if I were managing money, I just don't think that fee-adjusted returns are worth it.
Anyway. People need to focus on fees, and fees have come down a lot. The prominent managers, you pay 2 and 20 for performance that might not be, that great because now they're really large. But new managers, smaller managers, typical fee is probably 1.5 and 17 performance fee, potentially less. It's also diverted between individual investors and institutions. A lot of people listening to this radio broadcast may indirectly own hedge funds through their government pension fund or corporate pension fund. Big institutional investors, on average, are probably paying 1 in 10, maybe 1 in 15. So huge contraction. Also hurdles. Hurdle is for performance, and a lot of people don't want to pay a performance fee on cash, so they're saying, hey, you got to beat cash before we're going to pay a performance fee.
Well, this is my other question, and this may be a really ignorant question, but with the dominance of NVIDIA and the Mag 7, how does a hedge fund compete against that? Because at the end of the day, wouldn't they do just as relatively well, just buying the index or buying
I guess it all depends whether you think that those companies can continue to go up the way they've gone up. A lot of people.
But we have to wait for the Mag 7 to sort of fall out for then those hedge fund strategies to pay off. Is that the idea?
I just don't think you can. I don't think you can time it. And if you think that the equity market is overvalued, then you don't want to wait until certain things happen and then change your portfolio. You need to change your portfolio before it happens. And so one way is to hedge it. Another is you could also overweight certain factors through mutual fund index funds if you wanted, and underweight the S&P, overweight other types of indices that are cheap from a relative value standpoint to the S&P 500.